All righty. Thank you very much there, Raleigh. Um, Want to make sure I can get just give me 1 second. I'm trying to get my screen to where I can work both my monitors here. All right, I got that ready to go. All right. Again, thank you very much, Raleigh and Trading Pub. I appreciate this opportunity here. And for all those of you who are listening in, please feel free to ask me any questions as the day starts. Our website is pitintelligence.com. We do come live from the floor every morning, every trading day. We are here trading S&Ps and bonds. My background, again, just a little bit of a background of what I traded before is traded bonds here in the pit for many a year, about 20 some years, and about 5-6 years ago transferred some of this bond I guess knowledge, whatever it was, whatever you want to call it, to the screen, as I realized, as you can tell, unfortunately, you've heard that they're might close some of the pits, not all of them, but they're going to be closing some of the pits. So whatever knowledge I gained out of the trading pits, I had to transform them to the screen electronically, only because that's where everybody was going, that's where markets were going, and so we had to make a little adjustments here. The methodology that we use here, comes from many years of experience. We talk about, staying focused, trading in the markets that we know something about. The markets that we currently trade, like I said, the S&Ps and bonds, basically because they're right in front of me. I have a booth right overlooking the floor here on the S&P pit to my right, bond pit to my left here right in front of me, and options on both either side of us. And we do have a few connections to the floor, so we can talk to them and see what they're looking at, especially from the traders on the floor. I convey that information to our trading group and incorporate that into our everyday trade. I do trade for myself. I trade our methodology also, and stay focused. The reason I think we started the room, but the reason we started the room was simply so that we can have some interaction between a trader and a trade. I used to be in the pit, and you always get, you hear a lot of noise, you hear a lot of action, you know something's up. And when I was up in the office, and I traded up in my office for a while there, it was very boring, simply put. There was not much going on, and I got a little scared of the quietness, and I was trading, but I was like, wow, this is like weird. So got myself a booth on the floor here where the noise keeps me going. When there is something that happens, I'm aware. And then we got our room going here because I like the interaction between the traders. I try to fill in the void there between being up in the office and it being so quiet, and the fact that I miss all the camaraderie between the traders that I used to have. And so I got myself this little room here where we have good traders. We have some traders from the floor who do listen to us. Traders in the pits who are kind of listening to what we do, our levels, and going from there. So we got this room here just to keep ourselves entertained, keep ourselves awake, keep ourselves focused on the market. And sometimes when things get quiet or things get even volatile sometimes, and you're trying to figure out a reason why this is the way it is, or maybe you just need somebody to tell you that maybe you should just not trade, because sometimes the best way of making money is not to trade, believe it or not, because you're not going to be losing money, especially in a choppy trade that we've seen here over the last over the last week or so in the S&Ps, where we've been range bound trying to figure out which way we're going to go. But to that end, though, we're very careful. We'll pick our spots. We obviously we're looking for trends, but we're also taking price action into our into our scenario and we look at price action all day long to try to give us an idea of what the market's going to do next. I think that the one aspect of this business that is not algos or anything like that we don't know what's going to happen because they have these computer programs that come in there and just go nuts on us, is the fact that we take price action. The only thing that's kind of not tarnished as far as information flow that we can get that everybody else can have at the same time. So we try to see the price action we throw in price action into the methodology as well, and then in addition to that we have our levels that we use. We believe that the market goes up and down and ebbs and flows, and consequently we are trading the ebbs and flows of each market, and that's what we're looking for, support and resistance levels to get in and out of those in and out of the markets that we choose. Again, this is a more financial. This is more futures trading, so there's a lot more ins and outs. But even when I say that, we're looking maybe for 4 or 5 trades in a day, sometimes less than that, and more volatile, busy days. Maybe you'll get a few more trades in that. But we're aware of the cost of doing business. We're aware of how much it costs to trade, and we're trying to keep those limitations, those costs down, and giving us a fair opportunity to make some money. We usually look for about a 2-point stop in our trades here. So if you're not aware what 2 points are in the S&Ps, it's about $100 per contract, and we're looking for a 2-point profit potential as well. And to that end, sometimes when we do get ourselves into a nice little trade, we implement what we call a trailing stop, where I think anybody who's been trading for a while knows that you just change move your stop along as the market keeps going your way, and maybe we can, and we have are able to take more out of the market than our 2 points that we usually try to aim for. So given all of that, that's kind of what we are trying to do here, and we try to do it on a everyday basis, consistent basis. We take into account some of the numbers that are going to be released every day, the fundamental news that's going to be released. That also comes into play, especially when you have the Fed speaking and they're talking and doing their thing. We make sure that everybody's aware that the Fed is going to be communicating that day, and some volatility could occur, just like it did kind of yesterday. But even though yesterday, you get a little volatility, and then kind of market kind of just dies out. So, but you should be aware, and we try to make sure you're aware of any fundamental news that's going to be released every morning. And that helps us and helps you, lessen the risk, because obviously there's much more risk involved when you're not, when you don't know that things are going to be right around the corner. So again, when we get into the, show you some of the things that we do, and this is what we're going to cover here. Make sure you ask any questions that you have. I like the questions, and as we go along, instead of leaving them till the end, sometimes you have a direct question for what I was showing you at that particular moment in time, and it's a little bit easier for you to just ask me at that point. Anyway, what we're trying to do on this webinar here this morning, we're going to look and see how we're going to enter and exit our trades, why we enter and exit our trades. We are always trying to find reasons, and I think it's very important, especially when you are given opportunities to trade all day long, to have reasons why you're getting into the market and getting into a trade, versus saying, oh, the market's going up, I think I should buy it, and the market's going down, I think I should sell it. Because we need logical reasons why we're entering a trade, and then if the logic is there why the market's going up or down, then you have to find a proper entry point. And so we try to keep everybody on the right side of the market with our discussion, and keep tell you, if we get above a certain level, then maybe the market's going to rotate and go the other way, start going up. If we get below a certain level, well, we don't want to be long anymore, and we definitely are looking to be on a short side. Yesterday was case in point of when we had a level above and the market kind of topped out a little bit there. It was the price action told me, and relayed that information to our room that I think we were going to push off the highs and go a little bit lower. And then at that point, we're just trying to find entry points that the market gave us and was giving us. And we again, tried to find those entry points and traded and tried to get short to get to our lower levels below. So entering and exiting our trades, that's very important, and we need to have good logical reasons why we're getting in and out. I think that's an important aspect of trading more than anything else. I just don't get in, the informed trader and the educated trader is probably obviously a better chance of being making money and staying in this business long term, which is all we're trying to do here. And we're going to show you how to trade our pivots. We figure our pivot in the S&P is a little bit differently than maybe some of the conventional methods that are out there, where you take the high and low divided by a certain number and you come up with the same pivot that everybody else has. Well, if everybody else is having the same pivot, it's not really going to give you too much of an advantage. So we try to just tweak it a little bit and give you what the floor traders are looking at as a pivot that I think it has worked, and it does work really well. And I'll give you our levels that we gave out this morning. And when we go to the live monitor here with the live screens and live charts, show you where we were and how it played out today. We're going to look at the support and resistance levels that I mentioned that we're going to use as entry points and exit strategies for our trades. And then show you where targets are and why we would consider those levels as targets. I'm going to show you what we have as far as our Pit IQ, pitintelligence.com chart templates that we use every day. We have bonds and S&Ps on there, and I think they kind of interrelate with one another, and I think that's why it's an important to have both up there. I think once in a while bonds will lead S&Ps. Yesterday I thought it was the reverse. I think S&Ps were kind of leading the bonds until the auction results came out. The auction results came out for bonds this afternoon also, just when we started this, and they had an inverse effect that the auction results had yesterday. So, but again, those are the things that we have to look out for every day, and make sure we trade them accordingly. Make sure that you know that there's an auction result that's going to be released at 12 o'clock. It's going to make the market move. And today, some bonds here almost broke a point, and a point on a one lot is about $1,000. So it can get expensive if you didn't realize that was out there. How do floor pivots work if everything goes electronic? Yes, we've adapted what I will call our floor pivot to everything going electronic. Yes. So again, I've had to adapt here over the years so that we can keep trading, and that's what we've done. We've made tweaked everything that we've done here so that we try to accommodate the algos and the crazy HFTs and all that high frequency stuff that's out there that's traded, and we try to recognize and see what's going on. So we, as a trader, as an individual trader who you don't have the ability to get in front of a fancy algorithm or something like that. You have to learn to sometimes stay away from that, and then try to show you when things get a little bit nuts, how we try to stay away from those situations. Again, remember I said sometimes it's good not to trade. That's how you'll be making money. Again, we talk about that in our psychology part of our little webinar here, which I'll get to in a little bit. So yes, we'll use we've adapted the pivot so that we can get to electronic, and we'll talk about money management there a little bit also. We'll talk about how to the most important thing that I've always learned in this business is to make sure that you come back tomorrow. We can have a day where we're not doing too well, and look, every methodology is not going to be perfect unless you're Goldman. And you know, I don't think they've had like a losing day in like 3 years, but that's another story. But if you know, nothing's fallible, perfect, and everything's fallible, and you have to, you know, you can make sure you come back tomorrow because you know the stuff does work, and we have to, you know, be patient and let the markets come back to you know some sort of a reality, which we are always hoping for, and hope it does get back to. And then we'll talk about money management, like I said, and we'll get to that. So let's see. Let me see here. It is. Okay. Let me change the color scheme here. All right. This is a bond chart. This is a bond chart. Again, dates really don't matter that much. Prices don't matter. It's the setups that we talk about. The price action. You know, this is some price action over here that we're looking at and how it's setting up for us. This on this particular moment, this day was a you know, set up very nicely. Oops. Wait a second. All right. All right, there. All right. So this day kind of set up very nicely here because it just so happened that this first horizontal line here is our pivot. I know you can't read it. Oh, that doesn't look good. First horizontal line here is our pivot. And I'll just put a P here, a big P. I'm having a little bit of trouble getting the small print out there, which is okay. All right, let me try this. All right, anyway, so this horizontal line here is our pivot. It just so happens the price action when the market opened up kind of bounced off of it a couple times, right? And once, twice, 3, 4, 5 times actually. And so this price action is kind of telling us that you know it couldn't get above. It set up very nicely up there. Had a little bit of resistance up there, but once we again we didn't know which way the market was going. But what this told us here, once it held this pivot 3 or 4 times, and once we started trading below it, I think we were like trying to get short. So we got to give ourselves a little bit of a you know, 2 ticks range here where we, you know, try to get short here. Once we started to get short, the market kind of took off. Easily could have put ourselves into any kind of, you know, trailing stop situation to maximize some of this move. And it did come up here to our first support level, which would have been an area where we're going to take some profits. Bond market starts trading at 8:20 Eastern time. Okay, so that's 7:20 Chicago time, and then the S&Ps open up at you know, an hour later. So that's okay. Got it. I think I got this now. All right, there we go. Okay, so S&Ps open up, you know, an hour or so later, and the reason that they open up at 8:20 Eastern is to take into consideration some of the reports that are released at 8:30 Eastern time, where some of those reports are come out, and then you get some reaction to the market. And so we wanted at the time we wanted to be up and running, you know, when the markets opened up, and allowed us to get some opportunities to trade as the number was being released. So the number opens, we open up at 8:20. That's why not 8:30 or 9:30 like the S&Ps do, and these are Eastern time. Just because we wanted to be able, traders wanted to be able to take advantage of the numbers that were being released. Now, you know, take advantage is an interesting statement. I can give you a quick little story here. I don't know if some of you who are in the pit or read about bond traders, anybody here of Tom Baldwin, who was one of the you know, premier bond traders of our time for a while there, especially when the pits were rocking and rolling. And like I said, we wanted to take advantage of the number that's being released. Well, the broker that morning was buying it all, buying it all the way up. And Tom, this is a matter of, 10 minutes it's there. Tom was selling it to him, selling it to him, selling it to him all the way. Thing rallied about a point. Now, thing rallied a point in 10 minutes. That's like S&P's rallying, I'd say 20 points in 10 minutes. And then all of a sudden the number comes out and it keeps rallying. So, obviously Tom did not take advantage of the number that day because he ended up having a nice big chunk of, he had a very big down day that day. So when I say take advantage of it, don't really, try to take advantage of it, I say. But that was the reason we opened up 10 minutes before. Our charts are Central Time though. So I just said so. Yeah, that's where the charts are, because we are in Chicago. They do come up Central Time. Thank goodness. I'd get a little freaked out if they came out Eastern Time and I was in Central Time. Anyway, that's for another story. So again, we had a little bit of a sale here below this little, our pivot here. But we tested a pivot. You could have made a logical reasoning to even buy it the first time to it after this high, after this triple top. It came and bounced right back up. So you had an opportunity there, first time back up after the opening to maybe buy it off of our pivot. It gave us a nice little return. And now I'd be a little bit mindful here because we had, came up here once, twice, 3 times. I wouldn't have bought it here, but I would have been trying to sell it any place below that maybe. I would have been probably trying to sell it once we got below this pivot, and we did. Now, the only other place I would have bought it actually would have been above this this area right in here, those triple and double tops. I would not have bought it down in here, even though you would have thought that that would be a better place to buy it, because at this point right in here, this area right in here, after the third or fourth time too, it creates a lot of risk to be buying it right in this area. Maybe I would have bought it here after, the first time after this triple top, but then after that, and then it even held again. But after that, it'd be a little bit very, very risky for us to be buying it here. The only other place that would have been a viable buy would have been up above this area right here. So even though you think that that's, you want to buy it at a lower price, but the risk involved in buying it at a lower price increases immensely after 2 or 3 times bouncing off of that level. As you can see here, market kind of opened up and it gave us kind of a straight push to the downside. And so that allowed you to, maybe scoop some up here and at least cover. It had a nice little double bottom there, and we had a nice little rotation. So if, let's say, you were ebbs and flows in the market and you tried to get short, couldn't get short, came up here to our first support level, you could have made a case for buying it and taken a few ticks out of it. If you're counter trending, especially if we're staying below our blue band here, the blue band is basically just a Bollinger Band that helps us, especially in the S&Ps. I think works really, really well, where we do have nice bounces off of our Bollinger Bands to keep us on the right side of the market. And it does work very nicely when markets are kind of trending and it comes back to it the first time. Case in point here. When the Bollinger Band is kind of flattening out and or doing this, the reliance on the Bollinger Band is a little bit not there. But anyway, so again, you could have bought it here. Again, we're taking advantage of some flows in the market. We don't know what's going to stop here. The reason that we are buying it here is because it's our first support level. And so consequently, we said, all right, well, I have a decent reason to buy it. I know my support and resistance levels are working really well, so I have no problem jumping in at this level and buying it. And consequently, you have a little bit of a rotation and get a little bit of a bounce back in here. Again, we're not trying to hit home runs. I mean, you could have maybe sold it here and had a trailing stop and maybe been able to cover it here, and you would have had nice, what is that, about 10, 12 ticks on the trade, or you could have taken 4 or 5 ticks, especially if we're talking about bonds. That's what we're looking at. and then be happy with that, and then make this rotation, take 4 or 5 ticks off of this, move back in here, and been happy with this little rotation. At this point right here, considering this double bottom right below our support level, again, this would be the third time to it. I'd be a little bit mindful there. I wouldn't buy it there anymore. Even again, I would have to buy it the first time. This was a little bit a sale for us below our double bottom here, which obviously, as you can see here, brought us back to our next support level that we had, and that support level held very nicely. And I know you can't tell here, but this line right here is a trend line, which I'll get to in a little bit, from the day, a couple days before, and it kind of bounced off of this trend line very nicely. So we had a support level here, a trend line that kind of came in right in the same area. Okay, and again, when we have multiple reasons to enter into our trades, we take advantage of those reasons and get into those trades. I mean, you're definitely covering shorts if you got short from this level, and you're definitely going to cover shorts. And then if you bought them here, again, we're looking for a little bit of a rotation back up. We got it, and you take advantage of as it flows in the market. Now, when it came back here, I would not have bought it. I remember I said that risk becomes a little bit risky, even though we did get a nice rotation back up to this level. But to me, it would have been a little bit very risky to buy it here again. And then at this point, finally, it did break through, where I probably would have had a little bit of a sale. And, did not really give us it. We held below our blue band, as you can see. But once we got above our blue band here, it would have been an exit strategy for me if I didn't get my required amount of money. I mean, as you can see here, 11 to 12, you can see this is a very, very quiet time of the day where not much was going on. And the market kind of just subsided, did nothing much the rest of the day. That's a good question. The question is, do you recommend to wait 15 or 30 minutes after the open of the trade, or do you play the opening range? 30 minutes to an hour for daily direction. It's a very good question. It all depends on how much risk averse you are, is really the question, is really the answer. I think that everybody, risk tolerances are different, and what we do in our course, what we teach in our course, I don't try to get to try to change you. I try to show you or tell you what the risks are. I personally tell a lot of our folks that we teach to kind of wait 15, 20 minutes, especially if there's a number at the top. We open about 8:30, and a lot of times you're going to get numbers that'll be released at 9 o'clock. And these are central times I'm talking about. So you're going to be definitely, wait till that number comes out, especially if there's a bigger number. Some numbers are not as big as others, but if there's a big number that's coming out, then I definitely would, I would probably wait till that half an hour. So that's a very good question. It all depends on how much risk any one individual wants to take. But again, you have to consider your cost of doing business. And if you want to trade 10 or 15 times a day, then you could, trade more and get yourselves into more situations. If you want to watch, if you're watching what you're trading and you're watching your cost, then you wait the 15 minutes and you wait for the charts to get painted a little bit with the lines, because again, we do like to use price action to give us some idea. So that does help waiting the 15, half an hour to an hour even. The noise in the background, well, somebody wants to know what the noise in the background is. The noise in the background is actually a pit from the CME. I'm on the floor overlooking the S&P pit and the bond pit and also the options on all of those. So you're actually hearing live noise from the pits. And so not making a noise up on a recording. What are our stops? Our stops, we use about 2 points, like I said, in the S&Ps with 2-point targets. Again, we can extend those targets as a minimum. We can extend those targets if you have a trailing stop where we're trying to take a little bit more out of a trade. yesterday was, and I can show you today, there was a couple of situations where we were able to kind of hold on to a trade and take 3 or 4 points out of it. But for the most part, we're looking at 2-point stop for most of our stuff to keep us out of trouble. And then we can come back from being down $100, even if you're down $200 or whatever. Each one lot is worth $100 on a 2-point stop. Yes, I will show you when I get to my live charts. It's like once I go through the presentation that I have set up here, we'll definitely do some of our live charts from today. So just hang in there with me, and we'll get to the live charts. I know everybody wants live charts. I know everybody thinks that, yeah, I make this stuff up sometimes because I get perfect charts to show you exactly what I want to do, but I'm not trying to do that. It's not how I work. The charts that we show are obviously done so that we can show you something, but we also do have live charts, and we do get into the same things that I'll show you today in live charts and what we're looking at every day. So again, we talked about trend lines, just a little bit about them here. I showed you on the chart before where we had this line right in here. It was a trend line that we used from the day before, right? It came from the day before to 6, and I opened this chart up from overnight, and again, it came right down to our level here, where we had a couple reasons. We had the support level that I had, and also a trend line. So again, we talk about having different reasons to enter our trades, and the trend line is another reason, in addition to the support and resistance levels. Now, the support and resistance levels that I come up with, we put out, before the market opens. So, not, and in our course, I do show you how we get to them and how we adapt them, and so everything that I do eventually, you're going to learn and be shown how to do. I'm not trying to hold anything back here. And the good thing about our room is, especially if you're a trader, we're talking back and forth. We're having you ask me questions. I'm asking, and I get some information. Sometimes I do have a nice information flow here because I'm on the floor, and I get all the news right away. But sometimes I do, I don't get some information on a timely basis, where some of our traders will have that information, and I share it with everybody. But here are our trend lines, and you can see I drew the first trend line here when we got 2 spots, and then we hit it over here. And then we came through it again. So this is good. This is good. Maybe you want to hit again. You want to maybe buy it here the second time through. That's great. Would I have bought it here third time through? Probably not, right? So this breakdown and then came back up. So what I did was I adjusted the trend line. So we had a little bit of a same spot, but I had my 2 spots were here instead of this move here, right, where the first trend line went, because we kind of broke it, but then we popped right back up. So this adjustment of my trend line, intraday adjustment, allowed me to find this little dip back in here, where I'd say, listen, my trend line has been working today, and I have confidence in it because of this move, and this move, and then finally broke through. So I'm not going to lose confidence. I'm just going to adjust the trend line just a little bit, and it gave me that entry point here. Again, this is during the whole day, so you have to be a little bit mindful. Are we going to be trading all day, or if you had a few nice trades in the course of a day, maybe we're not. Everybody should reach a level where they're comfortable and what they have, and let's not get crazy by keep trying to trade to make more money. To me, it always gives you the opportunity to lose money. All right, so here's another little chart here where we talk about our targets. We talk about our, again, I will show you in real charts, but pivot was up here, as you can see. It had an entry point here to get short. It was staying below our blue band here, which is, our Bollinger Band. So you wanted to try to find a reason to be short this market. It was telling you wanted to be short. It was tracking down. It came right up to our blue band here, where again, this was a selling up. This was the first time it actually hit our blue band on any rotation. This was a little sell opportunity here, and it kind of you know, in this point, you know, you had all these tops here. This was an exit, especially if we got above our blue band, to get out of any trade. You don't want to be short. So I would probably said you want to be short, which is right around, you know, just about 72.5, and this is around 74. So it met our 2-point criteria. And if we got above this, so you had a reason to get short here, the blue band, you had a 2-point stop, which had been up here someplace above all these little tops where you don't want to be short anymore. And then consequently, you know, this was a good entry point where it gave you a nice little trade. Could you have taken a little bit more out of the trade? I think you probably could have if you had a little trailing stop and then kept moving your stop a little bit lower. You could definitely have gotten to this, you know, our target over here where whatever that our next target was, and you can see here it kind of sidewound here a little bit, came up here to our blue band. I don't know if I would have sold it there again. You could have. Again, it's all a matter of how much risk you want to take. You know, first time is good, second time is good, and now you get into a little bit be careful time here. But it did hit our next price level all the way down here. We got one up here at 68, then we got down here at 62. You could have bought this, made a nice little rotation up through, and again, this is just on the close, which we do not like to trade. So if I tell you to stay away from trading the first half hour to an hour, I'm definitely telling you you're going to try to stay away from trading the last hour for sure. Right after 2 o'clock Chicago time, when the bond market closes, you get all those algorithms kicking in, and we don't have a chance. I mean, I just hate to tell you, as a trader, you just do not have a chance. As much as I want to tell you, yeah, you should keep trading and try to make a little bit more money, but you get some price action that's so quick and so fast that, you know, you're not going to have that opportunity to get in and out. So it becomes a little bit of you know, an issue there for us to be able to get in and out of those trades. Again, just a little bit different way of showing you what we've been trying to, you know, tell you. We have our pivot right over here where the market did, you know, bounce off a couple times. This is a different chart than the first one. Bounced off a couple times, came back up to it, would be a little bit of resistance. Then that gave you a little bit of a push to the downside. Trend line, like I said here, from the day before, even sometimes keep them. I look to keep them for about 2 days. Be about it. It was also our support level, giving it an opportunity to get into it and get into that trade if you wanted to. And again, just kind of same thing, same concept, same idea. We redo. We make sure. We make sure you. Okay, if somebody's swearing and you can hear it, it's not me. Okay, so apologize for the swearing. But if you do, again, it's kind of the same logic, same methodology, same things that we're looking at. We're not trying to, you know, do something different. We have same logical things every time. They keep repeating themselves, and that's why we are always, you know, looking for the same things. All right. This is our template that we have up here. Let's see, blue line. I'll give you the settings. It's about 21, 22 on the Bollinger Bands. Okay. How do we use stochastics in your strategy? I don't, honestly. Maybe the longer term stuff, maybe a daily or an hourly stochastics I might look at, but the shorter term stuff, stochastics are laggers. They're not going to really kind of tell you what's going on. I'd rather look at the charts, price action for me to get an idea of where I want to do, what I want to do next, instead of having stochastics tell me which are laggers. Now, stochastics on a longer term chart, a little bit more reliable in the sense that it might be time, but again, longer term charts, daily charts, you know, you're taking a lot more risk and your stops are far and few between. So you're your mentality of trading in and out like we're doing, you know, your day trader is not there when you're looking at a longer term chart. So you have to decide, do you want to trade longer term? Do you want to trade, you know, be a trader? And if you're a trader every day, you know, stochastics are laggers and they're not going to give you the information you need to be able to react to the market quickly enough. So going from right to left here on our charts, we have a 5-minute bar chart, a 60-minute 5-minute ES bar chart, a 60-minute ES chart, then a 5-minute 30-year bond chart, and a 5-minute 10-year bond chart. And again, I'll get to our live shot here. You'll see those. Which I think. Let's see. All right, this is what kind of. So I give you here an opportunity to. This is our information for our offer. You have an open house. You can come into and tune into me. Like I said, I'm in daily. You can see definitely the rest of the week and obviously a couple more days. And you can see the link that Yana has put up there. You know, you can obviously go to our website, kind of do the same thing there too, pitintelligence.com. And you can just listen in, and if we can try to help you out, that'd be awesome in any way. But you'll be able to come in there and listen in for free for the next, you know, definitely the rest, well, yeah, definitely the rest of the week. Well, not today because we're going to be late today and coming back from this, but Friday and next week. And, you know, talk to us, see if we can talk to me and see if we can help you out in any way. And give you some idea if you like what we do and you like some of the ideas and concepts that we do. Definitely feel free to, you know, join us and see if we can help you out. I think it's a, you know, fun place. Obviously, when you're a trader, you love trading. It's kind of, you know, I don't mind sharing the stuff we do. I think it's, I think there's plenty of money out there for everybody. You know, you're trading thousands and thousands and millions of contracts a day. I don't think our 5 lot or 10 lot is really going to hurt us any. So I think there's plenty of opportunity there for all of us. And that's a nice part about what we do and the business that we do. So, you know, join us. Again, click onto our website there, pitintelligence.com, and or the link that, you know, Jana's put up. Again, if you do click on a link, and put in your right email, because we send you a, you know, a email every day. So all you have to just click on. And if you give us your wrong email, then we're not going to be able, you're not going to be able to get that email invite to click on and get in. So just you know, just a little work that we have to do there. All right. It all varies, Bill. We have different rates for different things that we offer. Course is one thing, and every day is another thing. So come into the room, and you'll be able to kind of get all that information. All right, let's go on to. All right, so let me let's try to jump here to the my monitor here, so you can see what's happening. And these are our live charts. Give it a second here to load up. All right, I think we are good over here. Just move this sideways. All right. So here's our, like I said, from right to left, this is a 5-minute ES chart. As you can tell, my 5s and my S's are the same. This is a 60-minute ES chart. And this is a 5-minute bond. And, oops. And this is a 5-minute 10-year. All right. So there you have our charts that we show every morning, and this is today's stuff that we have here. Let me open up our let's see if I can do this. Open up our bond chart here. So this is our ES chart here. Let me give you the levels that we had this morning, just as a point of reference. 74 was our pivot, 78, and then 83 above, and below we had 70 and 65. Okay, so above the 83, you've got 89 and then 94, and below the 65, we have 59 and 53. The 89 above is strong resistance, and 59 below here, again, I don't have them in there only because we didn't get down there. And again, these two are the strongest support and resistance that we have. We open up at, right before the S&Ps open up, about 8:15 Chicago time, so 9:15. I'll give you the levels before the market opens. Why do we use 10-year and the 30-year? As part of analysis, again, I think that they kind of interact together. I think that they kind of trade against each other sometimes, that they are, let's say, they kind of need each other a little bit more than anything else. And they sometimes one market leads the other, and inversely, and sometimes they trade the same. So there's a correlation in there between bonds and equities, and we try to find that correlation. Sometimes it's positive, sometimes it's opposite, sometimes it's the same. But there's definitely a correlation there in these markets as they trade. We also look at when we are trading, obviously oil has been a factor that we focus in on. We do not, I don't have it up. My buddy here trades oil next to me, and he always tells me if there's something going on there in oil. And so we kind of watch that a little bit as well. You have to find the interrelationships between the markets and what each markets are trading at any particular moment in time. Sometimes you get a correlation between dollar and the bond market, a dollar and the equities, oil and the equities. Lately it's been, kind of trading the same. So, you have to see which markets are interacting with each other and then go from there. So that's what we try to do, and that's what we're trying to do here. All right, so 74 here being our pivot, which is right in this area right in here. This is our pivot. And the market, as you can see here, had a little bit, this is what we talked about before, where we're, once, twice here, and then this is where we're, you're looking to see where you can buy it, a good buying opportunity. Once, twice, here's a buying opportunity. It's also above our blue band. We got above our blue band. And again, you could have used a 72 stop, which would have been absolutely acceptable. Which markets do I prefer, 10-year or the 30-year? I prefer the 30-year. I think they have more volatility. Everybody looks at the 10-year and gives you that, the rate when you hear about the markets and what they're talking about. But I tend to look at the 30-year for movement, and as far as movement and the markets are concerned, I think you get inverse trade with 30s than you do with the 10s, and the 10s also don't move as much. Bond market, though, I can honestly tell you, it's a creature on its own lately. It's in its own little world for many reasons. But we're not going to discuss that right now. But the bond market is definitely got its own little world going on here. It's got too much government intervention and too much stuff that's happening that's very hard for us to try to understand because there's so much money out there, especially with all the quantitative easing that they did, and it's kind of skewed the bond market a little bit. It's going to take them a little while for that market to get back down to actually trading like it used to. I mean, you're getting 2-point moves in the bond market like it's nothing, and that used to be like an exceptional day. But that's a conversation for another day. So, yeah, yes, the Bollinger Bands are at 20. Sure. So the relationship between our pivots, again, our pivots is there to help us you know, trade, to get an idea of what's going on. Pivot this morning was 74. We are definitely, maybe, again, we had a reason to buy. Maybe we had a top, and a bust through, especially a bust through above. Could have made you catch this little move here if you're aggressive, and this is right on the opening. Okay, so it goes to the fact that do you want to trade? You know, do you want to trade the opening? Uh, but if you do, you know, there is you have a reason to right there with these double tops. Market did go up here. Now, with what's been happening lately, and I don't know if you've been realizing, is that um, it's been kind of you're getting a 1 hour band that's, you know, 8 points, right? I don't know if the openings have been really nuts. So we warned everybody about that and about trying to sell this 78 level here, which is our first level, matched up with the overnight overnight high. So we had a little bit of reason there, but the way the market's been trading, we definitely told our folks here to be a little bit careful about that first 78 level. I would have definitely preferred the 83, but we only got up there to that 82 area, one and change, and then we came off. When we came off of this fake little high here, when we blew off, I call this a blow off top here, where we kind of made a high and then started coming down. Had a lot of trouble during retracing any part of this move. I was trying to tell everybody that we wanted to be short this market. We got a little bit of an entry point here, and I said we want to be short below this double bottom, which would have been 76. All right, that's where our entry point would have been, and had a little bit of a buy here, obviously against our 74, which has been our pivot. If we were looking, you know, if we got short here at 76, we're looking at 74 as our pivot. Now, this is also a first rotation back to our blue band as well, so you could have maybe bought a little bit better than 74, but let's say you bought the 74. 72 would have been your out, which would have been right here on a 2-point stop. Took about 5-10 minutes, but we did get a nice little rotation back up here above, back up to that 78, which, again, this was our earlier resistance point. You could have made a case. Again, it all depends on how aggressive you want to be in, but again, it's out there. You could have made a case for being short against that 78 level, especially since this would have been a very tight out here. I think anything above 80, again, makes sense. 80 would have been an out for the, hang on just 1 second. So we have to, we got to, so if you made a case for selling the 78 level here, again, because of our resistance, definitely gave you an out. But if you bought them against a 74, which would have been our pivot, definitely had an opportunity there to buy them and sell them up there at 78. And I did say that we want to sell them there if we were long in our course. Again, so now we're back in here. Nice little triple bottom there, and the market does this to us a lot of times, especially lately, where it kind of gave you a fake out move to the downside. As you can see, it did right in here. You know, just a nice little triple. This is below our pivot. This is definitely a little bit of a sale, but guess what? Everybody had this little move here, right? So when everybody gets this little move, the market is not going to go down, not initially. So if you did get short here and you saw that we didn't get any follow through or we stopped, no reason to take, leave it for 2 points, but I mean, you want to make this, grab it and catch it and make it, the market should have gone down like it did over here right away. Never did. It kind of rotated, bounced back up, gave us a lot of heat. Probably took you out of the trade if we were keeping it to a simple 2-point stop. But again, not every trade's going to work. But once we got through it all the way back here, then the market did go and give us a little bit of a trade down. Now, this area here was our short level, right? And this area came back up here was our resistance, right? You can see that. So let me show this again. This was a little support. Now this became a little bit of resistance. So now we have a little bit of a buy, and above, if you continue this line through, above this, and this also matched up with above being above our blue band. Could have easily had a case for being long anywhere above this level here, which would have been right around 74. That's right there, 74 being our pivot. So you could have made a case for being long here above 74 again. But again, you have to make a case for it. This was support. This was the resistance, all the same. This pushed us down. Now we had 60, well, we had 70 here. If you bought the 70s the first time to it, right, we never got down to 68. 68 would have been right in here. If you did buy the 70s the first time to it, you had to wait 10 minutes, but you would have had a nice little rotation back up here to the 72, just above the 72, right? I kind of jumped the gun there on the trade. So you had a nice little move here, followed by a nice little bit of a rotation up to above giving us our 2 points if you bought the 70s, which was did not click down, give you a loss. And then, so this gave you a little bit of a buy. Now, we had 65, which is all the way down here. We did not get filled on the downside, on our downside target. And just give me a second here. We're going to have these bells here from the floor. There's going to be 3 of them. That's the cattle market closing. Okay. All right. Sorry about that. So we did not come down to our final support here at 65. But like I was trying to say, we had little, we had a little resistance here, support here, then resistance. Once we got above here, once we got above our this little level up here where you could have made a case for buying it, it gave you a nice little double bottom here, which would have been a nice little out. Okay. Again, this is price action. I'm not making this up. This is the price action that you're looking at. Here and here, you had a little sale below here. If you wanted to be long, you could have made a case for being long anywhere in this area with an out, and this is what I would have probably told everybody in our class. This would have been an out for us below this little level here. But if you would have been able to, if you were, if you wanted to, you definitely we definitely would have told you to be long to catch this little move up here. Okay, that's the one thing we would have been easily telling you to do, simply for those reasons that we talked about. All right, and that's basically, and then the rest of the day kind of just, you had this little, an hour and a half rally from 74 to, again, you got up here just to about 79 and change, and then slowly started ticking back down. Now we're getting to this area here where both sides of our blue band, this value area, I call this a value area the market created, goes back to here, goes back to here, and if you really want it to, goes back to all the way over here. This little value area between the 78 and the 74 is kind of a dead area to trade. You're not going to get too much action here. This is a place where you want to stay out. I still, like I said, I like the 89 as a little bit of a sale up here. If you had a reason to buy them, again, probably you can't really buy them unless you got above 82. And the problem with the 82 level, we have 83 above. So, we just missed out here on our 83. We got up to 1.5. If it went up to 2.5, we like to enter our trades by scaling in. So if we had 83, we would get in at 2.5 and 3.5, and it still averages out to 3, right? But that's how so we kind of just missed out here on our entry point on this 83 level of ours. But that's what we kind of did today with our trades. I mean, you probably got hurt on this move, this fake out move here, because it was all a nice little triple bottom there, and then it got everybody short. Probably lost money on that, but we had a little bit of a buy here. We had tried to keep you short here the whole time, had a buy here at 70, again going back to 72, and definitely could have made a case for trying to be long above this level here, up here. So maybe 3 good trades, maybe 1 bad trade if we got caught on this little spike move. And it happens, we're not gonna, we're trying to, you have to try to get into a trade when not everybody else is into the trade. Otherwise, you're going to get, a little bit of trouble. Let me see. Bond market here, as you can tell, they had the auction results when we first started. They had a nice little, again, the concept of what we teach is simple. We have a little area there where market couldn't get above. Once we started getting above, that was a little bit of a buy. It gave you 3-4 ticks. Again, a little bit of a buy here, especially if the blue band rotates below it and we start trading above it. We could probably have a little bit of a buy here around about 16, and maybe could get us up to this 24 area, maybe even up here up to the 28 area in a bond market. Again, same concept, nothing different. So all of this stuff is interrelated. All this stuff comes due as the market comes due, as the market's trading. We're not trying to, make stuff up in the stuff we teach, and we're very consistent in what, excuse me, in some of the things that we do, so that obviously consistency is important, so that we all recognize the trade. And this is the one thing that we try to do is the hardest part, I think, from any trader's point of view here is the recognition of the trade, and then the hardest part is the execution. I think, okay, we're going to have these bells here again for a second, so just give me a second here. Okay, good. So, so again, we have 2 parts to the trade: the recognition that the trade is there, the recognition that we have a buy above this, okay, and are we going to execute? All right, we have we see this. I showed you these triple bottoms there, and then this. We recognize that there's a buy here. We recognize that this market, spiked low, starting to rotate back up. And now if it holds, we got to buy. And so we recognize the trade. Now, the second part of recognition is execution. Okay, and that's where a lot of people's problems is to be able to execute the trade. And I'm here to help you recognize the trade, and I'm here to help you, the more we see a trade, the more it comes around, the more, people are going to bite, and once you see the trade, and not everybody's going to recognize every trade. I probably can recognize a lot more trades than you will. The point is, though, you're going to, what I want you to do is to recognize trades that you see and to act upon those trades individually. Again, you're not all going to trade like myself. You're not going to trade like somebody else. You're going to trade like you. And so you want to make sure that everybody, whatever trades that comes to your eye, mind's eye, that you can see, that you recognize, that you are able to execute, because that's the hardest part. So somebody asked me about here, I prefer charts over ticks, range bars, all that stuff. Bar charts are easy for me versus candlesticks or anything else. They're just easy for me to recognize the trades that are coming up and to be able to act upon them. So that's what I like to use. Again, we use about a 2-point stop on more volatile days, okay? More volatile days where it could be a number right after a number, or it could be after a Fed situation. I didn't know those were there. After you might have to extend your stops to about 5 points or so. So, but very rare, and if that's too much for you, it's about $250 a trade, then we kind of hold back here a little bit. All right, let's get back to our can you guys see the slides or the PowerPoint, or do I have to flip back? Yes, you can see the PowerPoint? All right, great. Okay. All right, so talk about here in a few minutes that we have left over about the trading psychology, and then about money management really quick here. The psychology that we have here is is very simple, and I think it kind of goes to everybody's psyche a little bit. And that's what we're trying to do, is to keep your psyche on an even keel. So no single trade is important as the process of trading on which I must focus in on. And that's recognition of the trade, so the way I talk about it. And you recognize, you trade it, and whether you make money or not, it's the fact that you recognize the trade and execute it. That's the important part, and it's very important and like I said, I'm here to help you recognize, and then the hard part is for you to execute. But together, once you see the trades you believe in what we're trying to do, then you got much more confidence in execution. I believe it is not my job to know whether a trade will be a winner or a loser, i.e. that is to recognize it. It's my job to recognize the signals and act upon them. Again, it's your job. We talk about recognition. That's the one thing we talk about a lot. We talk about it, and then execution. You act upon them. That's your job. Be patient and wait for the opportunities. They will come. Yes, it is a big job. It's the hardest job ever is to pull the trigger. You're absolutely right. But what we try to do is try to give you confidence, and the money management part and the next part is going to be what we talk about. But to be patient and wait for the opportunities, they will come. A lot of people think that you got to trade this when you get to, like we're trading right now in this little narrow range and nothing's going on and market's not moving. So when that stuff happens, you got to stay away, but there's no reason for you to jump in and start trading. Like I said, sometimes the best way to make money is not to trade. And that's the part of being patient is concerned. When the time is finished, it's forgotten and focusing on the next opportunity. That's always important, and something that that you have to focus in on is to look at the next trade, look at the next setup, look at the next opportunity. Don't just sit there and look at one thing and focus in on the one trade and say, oh my God, I just lost on there. Like that, the spike, like I showed you on that spike, it was a sale there. I mean, I think everybody saw that it was a sale. All right, you broke through some support, hit some stops, and all of a sudden just stopped and reversed. All right, we didn't get it. We didn't get what we wanted. So you got to get out and look for the next opportunity. Next opportunity was going back down to 70, which was the next trade, and then buying that and hanging in there, and then you got your rotation back up. So those are going to happen. And money management, real quick here, we talk about, you always got to come back the next day. And I said that earlier. It's very important because, the one opportunity one day is not, or one bad day doesn't mean that this stuff's not working. It's not going to happen. You have to be very patient and wait for those opportunities that they will come up. So money management is a way to make sure that happens. And so just to give you a very simple way of doing this, if you have a $10,000 portfolio, all right, just so that numbers are okay. We're not going to risk more than 10% of that in one day. So that $10,000, now we're going to risk just $1,000 of that $10,000 every day. Let's say we're looking at 5 trades, right? You're looking at 5 trades a day. You could say you only want to do 4 trades a day, and you can change how much money you're going to lose on each trade. But if you're going to trade 5 trades a day, take your $1,000 divided by 5, you get $200 a trade. That's how much amount of money you're going to risk on a trade. Now, if you're going to risk $200 a trade, now you can say, okay, I'm going to trade 2 lots, 2 contracts, because if I lose 2 points on a 2 lot, that's on $200. So I can do that 5 times. If you make money 3 out of 5, maybe lose money once, or maybe scratch. Remember, there's 3 things that can happen with a trade. You can make money, you can lose money, and the third thing, which is a good thing, is you can scratch a trade, which means you can break even on it. So 2 things are good, and 1 thing obviously is bad. So we try to stay away from the bad one. But let's say you make money on 3, lose money on 1, scratch another, you'll be up on a day. So if you say to yourself you want to trade make 4 trades a day, then you're risking up to $250 a day. Now you can adjust your lot size accordingly. You could do 3 lots and kind of take 2.5, or you can do one lot and trade, you know, make it a 5-tick stop, 5-point stop instead. Whichever way, just make sure you keep your parameters the same and everything is fine. And that way you're always going to have an opportunity to come back. And if you think about it, if you have a $10,000 account and if you lose $100 out of your $10,000, it's like 1% of your account. So, you know, I try to take we try to take the mental game. You know, somebody said pulling a trigger. We're trying to make pulling the trigger easier. We're trying to, you know, condense it into something that's not something that you don't understand. Everybody understands that you know, if you see a penny on the ground, you might or might not pick it up. Well, if we're talking about your account, that's 1% of your account. So you could say to yourself, all right, I recognize the trade. I'm going to execute the trade. If I lose money on it, it's okay. It's 1% of my account. Okay, it's going to be opportunities for me to make more money. Just have to be patient and wait for them. So those are the things that you have to look for, and those are the things that we're trying to make sure you focus in on, and focus in on the idea of trading instead of not so much the idea of losing money, because that's what most people are focused in on. So focusing on making money, that's a good thing. All right, we got about a minute here. Does anybody have any last minute questions, literally, that you guys would want to ask? Again, please feel free to join us at pitintelligence.com, and you are more than welcome to come in the rest of this week and some next week and join us and see if we can help you out, listen to what we do, talk to us, you know, give us some of your experiences that you've had, and together maybe we'll be able to work together and to help you out. But definitely come in there for this week and next week, tomorrow and next week, and see if we can help you out in any way, and see if the stuff that we do can interest you, and is, you know, trading is fascinating and fun. Everybody that comes into Trading Pub enjoys what they're doing and loves it. Otherwise, we wouldn't be here. So, all right, no questions. Thanks again to Raleigh and to Yana for your opportunity here with Trading Pub. You guys have been very helpful to us.